this section of Dodging Bullets is about litigation, claims and everything related to it. What we're trying to do here is not teach IPs how to bring claims. The people who know how to do it don't need teaching, and the people who don't probably are not going to learn in sort of a 30-minute webinar. So what we're really going to focus on is the bullets that we're going to dodge, and Andy and I are going to just sort of talk around the issues we see currently in the market and the things that can bite you later if you haven't got it right. So shall we start, Andy?
Yeah, I think perhaps one of the first things to clarify is the effect of the bullets that we're trying to avoid. And that effect generally will manifest itself as either a regulatory action brought against you for failing to act as the regulator thinks you should, or alternatively, particularly with litigation, you can end up with adverse costs orders and all sorts of other pecuniary penalties coming your way. And the bullets that exist broadly fall into four categories, and they broadly fall along sort of the four stages of such a case. So the first one is going to be the investigation section. This is, for most people familiar, it's your SIP2 start and doing the investigation, getting the records in, speaking to the right people. The second stage is then going to be getting advice. Usually it would be from a lawyer. The third stage would be preparing the case so that it can be brought. And the fourth stage is how you actually realise the asset of a potential action. And that's going to stretch all the way from an initial offer of settlement through letters before action, Part 36 offers, mediation, also possibly going to trial, how the IP funds it, and whether you pursue CFAs or if you have a litigation funder involved. And I think that covers most of the main bullets that would come about from these sorts of actions.
Okay, so I mean, we'll take them in order. I mean, a good way to think of it is SIP2 all the way through to dividend. I like to sort of challenge convention, for a better word, but if you think of litigation claims as not being assets, it's a bit of a misnomer. Litigation is a method of realising the asset. The asset is the underlying claim or shows an action, to use the better term, and it's often something you've got to find, you've got to dig it out, and the quality of your starting point often affects how the ending, what end point you reach. A lot of it is basic stuff. It's stuff that most IPs can do. It's different strengths and weaknesses, but understanding and getting the information together is a fairly obvious starting point that most IPs ought to be able to do to a sufficient level to get a claim together, I'd have thought.
Yes, and there's not that many particularly harsh bullets in this section that will cause you great harm as an IP. One of the main things to remember, particularly if this isn't the bread and butter of what an IP does, is the potential to jump the gun. If you start suggesting you've got claims against someone, then you quickly lose the ability to demand that they cooperate with you under Section 236. And if you get your Section 236 wrong, that's still an application to court. So it can still come with the potential for adverse costs if everything goes wrong. But other than that, it's mostly something most people have an idea of how to approach. And at this point, it's difficult to get yourself into too much trouble, save for if you miss something that's glaringly obvious, then a successor IP or the regulator on a complaint might come and question the decision making at that point.
I think that's right. I think you've got to firstly get in everything. I think there's two parts to the getting in bit. I think IPs nowadays understand getting in the records. If you fail to do that, you're in trouble. So the getting in record phase should be fairly automated within the system, should be checklist driven. It requires a level of intelligence to look what and where, appreciation of stuff held in the cloud, electronic data versus paper data. Getting in 20 boxes of records isn't great if they're 20 boxes of records that go up to 3 years prior to an insolvency. Getting passwords to, you ask for the data but you don't get the passwords. I've seen IPs get into trouble over that. So get it in, and have a look at it, read it, understand what you've got, ask the very simple questions about, well, how could you run a business without knowing where your accounts are, where your management accounts are, put a bit of pressure on, without having any purpose to making a claim later. I think that's quite important. Every case should be the same. You're just simply getting it in. I think most IPs nowadays get that. I think I very rarely see examples where they completely fail to get it, except for the odd drop in the ball. But pretty much everyone's systems are geared up to be the same way. So I think the sort of investigation phase should be the easiest. Is what you do with the records afterwards. I think is where the problems might start.
Yeah, I very much agree with that approach. And the only possible addition would be that, and you alluded to it at the start, is that getting in the records is not a one-shot effort. There will be times when you get records in, and then you need to carry on getting more in because of what you found at the first stage.
Yeah, third parties using the 236 powers, information from bankers, creditors are a great source of information. If you think about most claims are really fit into two groups. It's damage to an asset of the company, selling something too cheaply or something like that, failing to pursue an opportunity. But most of the claims in insolvency are damages to creditors, trading losses, preferences are where you need to prove insolvency later on. So certainly very early on the stage, getting creditor questions out, chasing them up, identifying who the most valuable creditors are, for want of a better word. In a typical case by volume, HMRC have got good independent records. Normally they're the victim of an insolvency. There'll be returns which are signed by statute under statute by certain people. So having all that material in your hands is effectively the claim. Often the way to think about a claim is the claim is equal to the insolvency of the business. If there's a shortfall of 200,000 or 300,000, that should be in your mind as your starting point for a potential claim. You've got to make good on that claim. You've got to get the material done and make it into your systems very early on. Then you can move forward to something more complex. But without that start, you can't get anywhere.
Yeah. And then the next phase will then be how you review what presumably will appear to the insolvency practitioner as a potential claim. And in the parlance of normal assets, this would be where you'd speak to your agent. Now, because it's got the potential to end up in court, here one will usually go to a lawyer for advice. But a number of the same requirements and thoughts of instructing agents apply here. So, and the case of Iqbal is an extreme example for showing the importance here, is if you go to completely the wrong person for advice, that will not absolve the IP of their duty to obtain the best price. Now, Iqbal was an extreme case. It was where the IP only went to the director for the value of a fairly niche asset, being channel numbers on the Sky broadcasting system. But the IP's argument was, I went to the director because he's an expert in this. And the court said that wasn't good enough. And a similar thing is going to arise when picking your lawyers. Again, if you want to take an extreme example, going to a high street property conveyancer for advice is probably not going to be suitable. So you're going to have to make sure it's a law firm with the requisite experience and skills, knowledge to consider and then review. And as I'm sure we've all found during our careers, insolvency is quite a specialist field of law, particularly when we interact with lawyers who don't have great experience of insolvency. You can sometimes see them almost fumbling to try and grasp how insolvency is very different to a lot of the other areas of law in how it interacts and the duties that arise. So the prime bullet to dodge here is picking your lawyer carefully. And were I putting on the regulator hat, I'd say documenting the decision as to why you picked that lawyer, so that if anything comes of this, and as usual, when it does come, it will be 4 to 6 years down the line, you're not trying to rack your brains for why you went to that lawyer. There's a clear decision and you can just produce that to the regulator, and that ends that query there.
Well, I suppose around this phase, this is where I would say there starts to be a divergence in quality of, or difference in IP rather. I could litigate. I'd be a bit rubbish at running a care home. Other IPs probably run a lot of care homes and never litigated. Every IP is a sort of general practitioner, and the principle behind how you approach your work is if you're a specialist IP in a particular area, you've done a football club, for example, then you go in on day one and you sort of know what you're doing. And really, you still probably sort of know which agents to ring straight away and help you out in actually doing the work. Whereas if you've never done one before, you're relying more heavily on the advisors. And I think what an IP does is their first question under ethical rules is, do I have the capability to do this job? Do I have the skills? Do I have the staffing, etc., capacity? Rarely do IPs decide that they can't take on the fee-paying job. But they need, in answering that question, what they're really being invited to do is to surround themselves with advisors who understand the question and the answer. So if you envisage this at this stage, you've got some books and records in, you've done an investigation, some things have come out of it. You may not quite understand what they are, but you're aware that you've got some records which show bad things, some interesting emails, some documents, accounting knowledge which shows that the company was insolvent for a while or an asset's gone missing. I think it's the crunch point where the IP, the character, the personality, the skills of the IP start to come into question. Because not only is the IP selecting their advisor, but they're also got to receive the advice. And you can pick your advisor to advise what you want to hear in many ways. A lawyer is generally a cautious beast. So if you go to a lawyer who never litigates, go, everything's all too dangerous, then you can probably cover your file and say, yeah, it's too difficult. Yeah, but I wouldn't litigate on this massive wrongful trading. Wrongful trading is impossible. That's fine as far as it goes. I think on a regulatory basis, you're probably fine because you got a lawyer to say it. I'm not sure in 10 years' time that file's going to look that great, but where you stand at the moment, getting some advice telling you to do nothing is often a safe bet. However, I think given the more purposive role of IPs, you've still got to look at the potential claim as an asset and think about it still might be valuable to somebody else. And with the recent reforms where you have the ability to assign causes in action, even a dead case to you might be worth £1 to somebody else, or £1,000, or £10,000, or £1 million. So you have to think, well, getting advice that just says close it, is that really a good idea? It might be if it was examined in great detail. You go to the same lawyer every time who gives the same advice to never pursue this, never pursue that. That will start to get you into difficulty, I think. Within one file, it's fine. If there's a pattern of behaviour, then there's a problem. And you're going to be up against other IPs. If there's one IP who takes on your average 10 CVLs and litigates on 5 of them, and you take on 10 CVLs and litigate on average none of them, that's going to start showing. And so I think the bullet the IP's got to dodge is to make sure that they get positive or best advice in picking their advisor, second opinions. Bearing in mind the IP may not fully understand what they've got, so they're relying heavily on the advice, but put themselves in a position where they're getting advice from somebody who can at least ask the right question, or if the question is answered, understand the answer.
Yeah, and I think one other extra point someone might consider is to make sure the communication with the creditors, particularly where a decision is made the claim isn't worth pursuing, is clear and complete, and maybe offer to the creditors at that point and say, I've looked at it, I've taken advice and it doesn't look like it's worth pursuing, but I have noticed something that is there that is a potential issue, a potential claim that might exist and might in the right hands be worth pursuing, and let the creditors then have those options of, if they want to fund, say, a second opinion or to appoint another IP to look at it or something like that. If you as the IP don't really have the taste for it, then suggesting to creditors that they've got other options available is, I think, always going to be looked on favourably by the regulator, because you're not just destroying any possible interest or any possible chance that the creditors have got of this asset being realised or potential asset being realised, and you give them some power and control back once you've done as much as you feel you can.
I think that's right. I mean, I'm currently in lockdown, and my daughters have opened my eyes to selling second-hand gear. The stuff online where they're selling old shoes, bits and pieces of furniture, stuff that you'd almost give to charity. They're selling 5, 10, 20. They're constantly going down the post office and delivering little parcels they've made up and things like that. It's valuable to somebody. A lot of in the current economics, people understand it may be worth nothing to you, but it's worth something to somebody. If you've got potential claims and you've done the investigation, then sell it. Sell it for something. Assign it, distribution in specie to creditors. There are so many methods to make it easy for the IP to send it from their desk to someone who can turn it into money. Then that seems to be bordering on negligent not to have considered it, and that would apply to someone like me who litigates a lot, and I turn it down. I know it's a rubbish claim. Should I still, with my experience, turn down, not bother trying to assign a case that I think is rubbish? In reality, I don't think the cases I think are rubbish, that I can't prosecute in any way, are rubbish. I think I'm fairly comfortable that we've gone round the houses and trying to find ways to extract value from all sorts of minor claims. So I'd be pretty happy with my systems, but they could always improve, and there's always ones they miss. You just made me also think of the point about in terms of the danger. If you're an IP of a company in liquidation, there may be claims. You close the case. If the creditors are unhappy, they can appoint another IP, or they can reopen the case. You've got 6 years normally to bring the claim. That happens. We've got a few of those happening at the moment. It's not the greatest thing in the world to be the IP on a closed case that you've missed a claim, but there's no loss, and I think that's the important thing. If you don't fight it, if they think there's a claim, help them get appointed, and if they turns out they spend a year investigating and there's no claim, which again I've been in that situation, then that's the best thing. What you don't want to do is prevent the investigation going on at all. You want it to be brought within time, and that really comes into play with administrations. If you exit administration to dissolution rather than through a subsequent liquidation, one of the things you do lose forever is the antecedent dates, the relevant dates for antecedent points. So if there was a perfectly good preference or transaction of the value in your administration and you missed it and you close it, automatically that 2-year or 6-month window is lost, can never be got back. It might be brought under another principle, but transaction of value and preferences are fairly unique beasts. So it makes the claim a lot harder or impossible, and that could be a claim against the IP. So it's very important to assume that there's an asset until you've exhausted all reasons for there not to be. Because plenty of other people can turn just normal insolvencies into claims, so why can't you? That'll be the test that you'll be set up against.
And I don't want to stay on this point too much longer, but there is one thing that did come to me there where you were saying about assigning claims. And I think it's less of a risk in corporate insolvencies, but in bankruptcies, of course, there's always the risk of the bankrupt claiming they've got a claim and they want you to assign it to them so they can pursue it. And of course, I think it's Hart v Hunt is the case where if it's a vexatious litigant and a vexatious claim, then the IP shouldn't really be assigning those sorts of things. So if your advice is good and strong that there is definitely no claim, then you might have to occasionally pause. Again, far more in bankruptcy, I think, than in corporate, to check to make sure that this isn't going to land you in some trouble.
Let's not revisit all my horror cases. Let's move on to the next bit, I think.
So the next step is polishing the case, and there's not a huge, for me, number of specific bullets here. You can quite quickly get into a rerun of the last 2 bullets, because at the point of polishing, generally you'd expect the lawyer to say either yes, I think this is a claim, let's go, no, there's no claim, or there's that wide ambit of middle ground, which is there might be a claim, but if we speak to this person or get these records and review them, then we've got a better idea. So you revisit those potential Section 236 risks. You have to be very careful what you've written in your file as to whether you think there is a claim before you start doing it, again, to stop you losing the Section 236 powers. and again checking to make sure the advice you're getting is correct, up to the point of where you get the claim ready to start making demands.
And that's where you are really getting away from the standard IP work. You're starting to get into specialist areas. The better you are as a litigious IP in that point, the better you're going to do this phase. As you say, it's a short phase, but it's an important one. It's standing back, thinking about the whole claim before I get on to how I prosecute. It's just thinking my options. The recent case we had of Wow Internet is a good example. I mean, it's something we've done for years, but Wow Internet seemed to encapsulate it quite neatly, where the first phase is don't produce much in the way of records. You've just got the losses of creditors and a director who didn't keep many records, or if he kept records, he's never going to show you, and litigating on the basis of that and understanding the how evidence works and how the structures work to turn effectively no records into a £50,000 to £100,000 recovery. And that's the bits where you've got to have picked your lawyer correctly in the previous phase, who understands the next bit of the phase and isn't there just to simply be a postman for certain basic stuff, who refer to last job or whatever. They've got to be able to run a case through to litigation. Otherwise, they're probably not worth appointing on the first step.
Yeah, and I think the key point for this sort of bullet is the border between this and the next stage. This is, if you like, I kind of think of this as the last cheap stage for making mistakes. Because your next stage is you're really generally embarking on litigation, and once you sort of open that Pandora's box, the potential adverse costs and just costs generally go up at a very marked rate. And so this is your last chance to sort of take a deep breath, make sure you're happy with what you've done as an IP before you step over the Rubicon and then find where you are.
Well, let's crack on with the last phase then. So the realising strategy, you've got a claim, you've been advised there's a claim there. It looks like a claim. You've got a sort of, we're assuming a powder and shot phase. You sort of had to look at the person you're going to sue, because if they've got no money, doesn't matter how good your claim is. So you need to understand truly the respondent's position. They may have already appointed lawyers. There may be a whole raft of pieces of information there, but you've got to put together, and you and your lawyer have got to turn this into cash, I suppose, is the next thing. So you've not litigated, you've not done anything, you've just done your internal bit, and you've now been able to firm up into coherent structure a claim. What do you do next?
And I think the key point here is getting the good advice. The obvious one is making sure you do your pre-action letters, because that can get you into all sorts of cost issues. But I think the most important point here for IPs, particularly with regards to dodging bullets, is thinking about how you're funding the case going forward. Now, assuming you're not in the fortunate position of having significant funds in the case and creditors that want you to apply those funds to this litigation, generally there's going to have to be a decision made as to where the risk lies, and that inevitably starts to bring in the inherent conflicts that are associated with being an office holder as an IP, between you wanting to get paid, you not wanting to shoulder all of the risk burden, but then how that's shared out across, be it solicitors with CFAs or DBAs, or as one sees more and more now, with litigation funders who will offer to fund or to purchase the claims. And how you approach that is, I think it's something we've looked at quite a lot in Griffins, and we take a view, because we've generally historically gone for a funding model where generally the practice has shouldered more of the risk than perhaps other firms would be prepared to do. And so we've watched with interest as the litigation funder market has developed. And I think it's one where, I think Steve, you'd agree, you still have to be careful how you approach that market.
Yeah, I think this is the big bullet in the case. The danger is that you've now gone from a concept of maybe an argument about a claim to advice. You've got a claim. It is now a real asset. It's now a 3-bedroom semi in a suburb somewhere. You've got to realise it. And you've done your checks and you think, yeah, it's worth money. So it's all downhill from here. You can only make mistakes. You're damned if you do, you're damned if you don't. If you don't pursue it, you should have pursued it. If you pursue it and get it wrong, then you shouldn't have done it that way. That's where all the issues really lie. And you've got a multitude of advice, a multitude of choices. You've got salespeople who want to buy your claims. You've got people who want to challenge this, want to do that. And then, of course, we've got the other side who say it's outrageous. How dare you suggest that you've got a claim against their lovely, fluffy client? So everything is now screaming. So this is the path you set yourself on. And again, looking back through the different previous structures, you need to know that you're going to get to this point, and you need to make sure that you are robust yourself, or you have the right advisors to help you through this phase. So in terms of, from my perspective, how I think IP should approach this, best practice now and also looking to the future is, I think we have so many advantages: the ability to sell, the ability to assign, the ability to fund in all sorts of different ways. I think you've got to go back to basics. It's an asset. You've got to carry the creditors with you. You've got to look at what package adds the most value. You've got to look at self-interest conflicts. Someone who offers you a couple of grand or 10 grand up front to cover your fees, so you're out, don't worry about the claim, is really hazardous. And I was talking to a lawyer just last week about a proposal like that, and they were just advising their client, don't go anywhere near that. You would need to understand your duty first. You're a fiduciary. So you've got to understand everything you do is in the interests of the creditors. You've now got a valuable asset, and you've got to turn it to cash. And often people think litigation, and they forget that there's all these other tools that are available that you can use. I think Tony Benn said something like conflict or war is a failure of politics. Litigation is a failure of negotiation. It's almost compulsory to mediate nowadays. So why not? The first thing to do is to talk to your respondent in whichever format you wish, WP meeting or in letter before action, and set out the claim, set out the evidence. I've had some lawyers that want to sort of hold back in a very short letter because they want to get on with the claim. They don't want to tip off the defendants in how they might, how strong the evidence against them. They want to do all sorts of tricks, and I really, really hate that strategy. I think you've just got to be straightforward as an IP, set out your claim, because I think, particularly at the LBA stage, if you can write a good LBA document that's coherent, not full of huffing and puffing and threats and we're tough guys and we're going to get you. If you just simply set out the mechanics of what the test is to be met and you've met it, what the evidence is, the other side have got to deal with that. The other side is advised by a lawyer, and the lawyer will tell them the strengths and weaknesses of the arguments, and then go through a correspondence phase, go through a negotiation phase, go through a mediation phase. You don't have to issue proceedings. And what you don't want to do is run up against a sort of 6-year limitation where you have to issue. You can issue and then stay proceedings and settle and things like that, but you really want to understand all that process and then come back to, right, so should I do that myself? Should I sell it? Should I get litigation funders to fund some of it? How is a litigation funded case appear to the other side? Because at the end of the day, what you're after is a check from the other side. That's the act of basically demanding money from somebody else on the basis of an idea, of a basis of all that stuff you've done before. If your investigation was good, if the documents are good, if you understand the game, you're putting to the other side, these are my cards. If we play the game, you're going to lose. Most often, you'll have a decent chance of a settlement. And that's got to be the way to go. What you don't want to do is treat the the case like a sort of Homer Simpson at the start of The Simpsons, where it's the nuclear ingot that sort of it's bouncing around his hands and falls out and goes in the back of his hood and stuff like that. It can't be a hot potato. You've got to be able to say, this is an asset. I'm tooled up to proceed all the way to trial. I understand the issues. I can get it litigation funded, or I can fund it through CFAs, or I can assign it. But whoever it is, you end up paying, and you've got to look then at what choice gives you the best outcome. There's a lot of discussion in the market about litigation funding, funding versus assigning a claim. I hate the idea of assigning claims. It detaches, even if the IP, let's say, takes £1,000 up front for just covering key legals and gets 50% of the recovery. The problem is that the decision maker now on the claim is the litigation funder, and they have no duty whatsoever to the creditors to whom you have a duty. So what you're doing by assignment is effectively entering into a sort of partnership with someone who has no duty to look after your interest. So if the litigation funder advances £1,000 for your 100 grand claim and then settles it for 20 grand immediately, they get £10,000 back for £1,000, brilliant, and you get 10 grand. Respondent pays 20. Now, to be honest, if you're not good enough to have written that letter yourself and made your threats yourself and settled and made an offer of 20 grand for a 100 grand claim, and kept the 20 grand for yourself, then you shouldn't really be at this point in the chain. You should have taken advice and got somebody else to do it. You could have made a Part 36 offer. You could have done through a whole load of processes. Assigning is sort of not quite desperate, but it's a point where you really need to have very clear notes on your file as to why you thought it was a good idea to assign. What value is added by the process that assignment is better than funding? Because as funding, of course, the IP is still the decision maker. They can still ask, what is the return to creditors? They can say no to settlement offers. Even if there is a team around them that understand it far more than the IP still is the guardian of the duty. And that's the issue. Assigning claims where you're the owner of them, if you're a bank or a commercial company with a debt and it's too complicated in your balance sheet and you want to get rid of it, and your shareholders agree, that's a shareholder decision. That's absolutely fine. But in an insolvency, you're going to be heading towards creditor sanction for selling a claim. It's such an obvious conflict of interest for an IP to cover their fees at the cost of the creditor's interests, that it's bound to come into regulation sooner rather than later, that you cannot sell a claim without getting some form of sanction. Got to be. You might think the lawyer advising you to do it would cover you. I was looking at a case the other day where the case had been litigated. It was assigned for a fixed amount from an IP who wanted to close the case. When you look behind it, the lawyers acting for the litigation funder were the same lawyers that acted for the IP in advising them to sell the claim. So the lawyer had a skin in the game. It doesn't look attractive, and that's going to be a bullet that's going to catch an IP sooner rather than later, because it's so obvious. It's so obvious. It's an obvious conflict. It's such a huge valuable money. Litigation funders make millions, and they make millions by buying claims cheaply and settling them for a massive discount on the face value quickly. That's where they make really top money, and that's not going to look good. The more money they make, the less was available for creditors, and it's not credible to think that it was the litigation fund that added anything different. They're nothing different. They use a lawyer. There's just nothing to it. There's nothing to it. They don't litigate any better. It's just it can't litigate any better because you could litigate the same. We would compare ourselves looking at litigation funder outcomes and things like that, and just looking at how they run cases compare we run cases. There can't be any difference. It just doesn't work that way. So the IP's got to be careful that they don't end up sending a claim for £1,000 that ends up in court, where the judge is going through and saying, I just want to make a comment here that this was a very simple claim for £1 million, judgment in favour of the litigation funder, but it does disturb me that X IP sold this claim for £1,000, as it was bound to rights. that's going to be where the first case of an IP getting into serious trouble will occur. And you're going to have no sight of that whatsoever. It's just going to happen, whether you like it or not. Your thoughts?
I agree with pretty much everything you said there. And for myself, the two key takeaways from when an IP is interacting with litigation funders. The first one is, as you touched on, the solicitor might not always be entirely on your side, because they will have skin in the game if they've got whip, and they might very much be interested in, if they suddenly see an option to be paid as they go rather than relying on a CFA, then that's going to be very attractive for them. So they might not always act in your best interests. I'm not suggesting they're Machiavellian in any way here. It's natural from the position they're in. And I think the second one is to understand in some way the pricing approach of litigation funders. And I know you've had a few thoughts on that, and to try and get into the habit that the funder is arguably just similar to any other agent assisting you in realizing any other asset at the point when you're negotiating with them in financial terms. And there is a strong argument that you should always be approaching 2 or 3 litigation funders at any time to test the market, because that will always protect you as an IP if you can quickly and simply evidence that you have attempted to test the market, rather than having to say, well, there was this one IP who I met at an event at some time, sorry, one litigation funder I met at an event one time, and so I just started selling cases to him because I got a return. You know, the two different approaches there are going to have a markedly different response from the regulator. But it is important, I think, for the industry, the IP industry as a whole, to start to gain an understanding of the pricing approach of funders to assist in coming to agreements with them.
Well, I can't believe there isn't, or maybe there is, and I don't understand it, but a broker or a series of brokers. I mean, it's a bit like, an IP boasting that I got lots of bankruptcies and sell lots of houses, and I always sell them to the same guy. I mean, it's absurd that one litigation funder fits all. You might have some that specialise in smaller claims, but I can think of 2 or 3 at every level that I deal with. So I'm aware of competition at every level, and so there should be. There's a the soundbite I think you're referring to is the sort of litigation funders price like it's risky, but they only invest in dead certs or near dead certs. They only advance like it isn't risky. So the returns that litigation funder will make are healthy, to say the least. And if you understand how they price and what they're willing to offer, then walk away, go down the road and think, well, okay, well, I'll find someone better. It's perfectly fine to go to litigation funders, not be happy with the price, and go back to creditors and say, I've been offered this. I mean, go to creditors and offer the same returns. I've got a claim for 100 grand, say, litigation funders offered me £1,000 plus 50% return. Any creditor want to beat it? Not only is that healthy competition, it's covering the IP's back, because the creditors are your masters. And if you've offered the creditors that role and they've turned it down, then they can hardly complain later if the litigation funder takes 50% of the recovery, or whatever percentage it might be. So why not get creditors regularly involved? Particularly if you've got a portfolio of creditors, then you'll look at the portfolio and think, lots of small traders, they're probably not going to do anything, fine. But you might have one minor creditor who's a bank, or some such, who might wish to lend to get a greater return than their dividend, as it were. There's no reason why you can't ask, or have it into your systems where you ask and there's no they may not reply, but at least you've asked them, you've offered it to them first. There's got to be a way of rather, the IP's got to have an approach of understanding what they're selling and understanding what's driving the pricing, and walk away. Find different ways. If you've been offered £1,000, then go back to write a letter to the other side and do a Part 36 offer for £20,000. That might be better. I'm about to sell this to litigation funders. Do you want to buy my claim off me? Is a phrase that's often missed. Why not? Haggle. Say to the litigation funder, a minimum amount of return may apply, 50% over and above a certain amount. There's no reason why you can't haggle. And I think, litigation funders pricing like it's risky, but only funding the certain ones, or the ones certain to settle. The IP should be the same. The IP should price like it isn't risky. It's nailed on. Think of a director's loan account. Director's loan account evidence is statement of affairs sworn by the director saying he owes the money, and their own accounts say they owe the money. What's the difference? It's not a claim. It's a debt, and it shouldn't be priced at 5p in the pound or even 50p in the pound. It's a debt. If they're worth the money, bring the claim yourself. It's not a risk. The IP really needs to understand that, and that sort of takes you back to the beginning. If you understand the whole chain, then go back to the start, and when you're investigating, think, I know how this will play out, and that's how you acquire more knowledge. And you go to the lawyers, advisors who have got the ability to see the end of the claim, and then say, well, that will work well with litigation funders. This is a case which is going to be expensive. It's going to require expert witnesses, disbursements that you can't really put on a CFA, that type of thing. So you're going to need a level of litigation funding. It doesn't mean the whole claim needs to be funded. You might have £1 million claim, but you need 20 grand for an expert witness. Then fund the 20 grand. Don't sell the claim because it needs for the want of a horseshoe, the battle was lost. Don't just stop at the first obstacle and think, oh dear, I better sell it. That's too complicated for me. That is basically admitting that you're not the right IP for a job, and that gets you into trouble.
Yeah, and I think that concludes most of the key sort of bullets to dodge as an IP. As ever, forewarned is forearmed. I'm not expecting anyone to just watch this and they can now approach any litigation case and be safe in the knowledge they're going to spot and avoid all potential bullets coming their way. But having them at the forefront always helps with trying to spot them and dealing with them as and when they can. I think is one of the key points here to take away for anyone.
Yep, I think that covers it.
Yep, I need to say thanks for watching, and hope you enjoyed it, found it interesting, useful. Our details will be on the screen for anyone who wants further contact or information, and no doubt there'll be a Q&A session following not too long.